The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, what did the Federal Reserve have to say about interest rates on Wednesday? How will that play into the market trade? We saw plenty of pressure in the soy complex, wheat on the day Wednesday, while corn was able to hold up there with more sales to China. We have plenty to dive in and discuss. Joining us now, our good friend Mike Zuzolo with Global Commodity Analytics is on the show today. Mike, good to catch up with you. And the Federal Reserve just here as we're getting going. Sounds like a 25 basis point rate hike. So I have to wonder your thoughts on that initial reaction and what that could potentially mean for the commodity markets as a whole to start us off here today.
I'm really glad the Fed did what they did with 25 basis points. They played it right down the middle. They matched the European Central Bank earlier this week. And I was very fearful that they were either going to turn off the interest rate hikes and really scare the market into a deflationary spiral, or take the interest rate up to 50 basis points and say, we don't care what happens in this market and in this banking system. We're going to keep on our inflation hunt until the inflation beast is dead. And I think that would have really tanked the WTI crude oil. So WTI is our best gauge right now as we get ready for Chairman Powell's press conference. We're taping right now while he gets ready to sit down and talk to the press. Let's hope he doesn't, quote, screw this up as far as the interest rate hike being, like I said, right down the middle. We got to realize last week, Jesse, that the big banks, small banks, all banks went to the Federal Reserve discount window to get liquidity because they couldn't get liquidity last week. And they socked in over 150 billion bucks. That was a record. That was greater than the financial crisis. So people that were saying this is nothing as bad as the financial crisis and the Great Recession, you look at some data out there, and I would disagree with that. So I'm really glad he stayed just on point with that 25 basis point hike. I'm hoping now with the crude oil back above 70, the dollar back below 103, kind of at that 102.50 level, we can close out the week and actually close out the month with a more firm dollar, more firm crude, and a weaker dollar trend. I think that would do a lot, especially in the wheat market, which we can get deeper into since that thing's been looking pretty bad again this week.
Yeah, we will definitely. I want to get into that wheat market here in a little bit. I want to start with corn and beans, though. Pull up on our feed. You sent me over some charts. We've been following the Nove Bean December corn spread here with you now for a couple of weeks. So let's just start here. Let's catch up on the latest. And, obviously I've seen plenty of pressure in that soy complex here this week, while corn sales to China holding things up there for the most part, more old crop than new. But just love for you to walk through what you're seeing here between corn and soybeans right now.
Well, a couple things. That high in this chart where you're looking at November beans divided into the December corn and seeing that it was up to about 2.46 times the price of December corn, that high right there was right around the WASDE report from the 9th of March. And we've now since fallen about 6%. That may not mean much in terms of that number, Jesse, but to go from 2.46 down to 2.31 in about 3 weeks, you've essentially lost 90 cents in November beans, and December corn is flat from where it was back in the report time period of WASDE. The 553.5 and 553.5 close in D's corn was where we were back on March 9th, and we're probably going to close around 556, 557 today if I had to guess. But that's what that spread and that ratio does as far as how much it can pull premium out of one versus the other. And I say this because a big thing about my independent analysis that I started many years ago was I don't want to know just why I'm right, but I also want to know why I'm wrong. And so I oftentimes go back and look at things and see, okay, were we right or wrong about the beans giving up because the wheat and the corn wouldn't support it. And there's a lot of discussion out there because of the South American crop and the soy meal market. Well, guess what? The soy meal market and the South American crop could not overpower what was going on in the wheat and in the corn. And the typical mindset came back in where you almost have to have all three of them kind of singing from the same hymnal. Now, coming in on that was also the fact that we did see a lot of corn purchases from China, very few bean purchases from China. That changed the sentiment. We also have seen the Brazilian soy market really crash. Paranagua is essentially $14.20 a bushel. We are anywhere from $15.75 to $16.25, depending on if you're looking at the Gulf of Mexico or the Pacific Northwest. And I'd say, lastly, we've got a situation where that meal market really did throw in the towel, led by the Chinese, led by the African swine fever. So I like the way the funds have been trading the beans versus the corn. It makes a lot more sense than it did earlier this year.
Well, and what you were mentioning there with beans, pull up another chart on the video feed looking at some of those prices. And to your points, I'm a little more concerned with this soy complex overall, especially I think on the board, Nove beans breaking below 13. That has me a little bit worried there, and I don't know if it's a gut feeling or what it is. So maybe walk me through a little bit more in this soy complex. Are you that concerned with some of the price action and chart movement we've seen in recent weeks?
I share your concern if we don't find some support right after the acreage and stocks report. And I'll say first and foremost, on that chart we're looking at right now, that green line is Argentina's soybean export price. That should be screaming higher and compensating for the steep drop in the Paranagua soy price. And this is what troubles me the most, is that I really want to see that Argentine market heat up here and kind of rebalance the trade sentiment, because especially with AgroConsult coming out this week and completely turning everybody's heads, I felt like an owl and felt like my neck could go around 360 degrees after I saw their numbers, where they went from 153 million metric ton crop to a 155. They went completely against the grain of the trade and the USDA and CONAB coming in with a bigger crop, as we are roughly probably 70% harvested at this point, 65-70%. So we should be getting some pretty good numbers at this point as far as yields. And so that AgroConsult number, if we're up 2 million tons at 155, you're right, it does scare one. And so what does that mean? Well, when it comes to the acreage and stocks report, it means either USDA is going to have to come in with the lower acreage, which I doubt that, but I think more importantly, the spread charts right now are still suggesting we've got an extremely tight bean situation. The July Nove bean spread, $1.50. Lead month May against July, still 20 cents over on the May, so still an inversion. These things matter as we go into the report, but they'll matter less if they're not backed up with some fundamentals.
Let's talk a little more in corn. You have another chart for us here on the video feed that I will pull up, and talking about some of this fund activity and the managed money positions in this corn market. Walk us through what you're seeing there, because I know we talked about it, and I've been just hearing a lot of talk recently about the funds and the positioning they're doing throughout the grains, but let's focus in on corn a little bit. What are you seeing here?
You know, this is one of the bright spots in the market, I think, Jesse. Not only do we have the soft red wheat, only about 35 cents above the corn at this point, so wheat should play a decreasingly negative role in the corn market, but we also have the funds now net short for the first time since 2020. That also should play an increasingly less negative feature in the market, especially the trade sentiment, because you and I have heard a lot about how long those funds were and how they were almost 250,000 contracts long. Well, look 4 bars back, and that's where you were with that almost 250,000 net long contracts in roughly 4 weeks. And thanks to the disparity of not getting the Commitment of Traders report in a timely manner, we can't say it's been exactly 4 weeks, but within a month we lost 50 cents in the front end corn futures, and now we're net short 54,000 contracts. I actually call that a win. If you're going to swing the funds from plus 240, 250 to negative 250, and essentially move 300,000 contracts and only lose 50 cents, I think that says something. And here again, the corn spread, the May versus the July, it's as high as the bean spread. It's at 21 cents over. And I think that's the highest it's been since September of last year. So something I think is being flagged in this corn market that the funds were out of position to begin with. And that's nice to see in and of itself. But B, the corn is really holding up well. And I think we would be over $7 in the futures had it not been for the wheat market. And I think this chart supports that.
We are having a conversation today with Mike Zuzolo of Global Commodity Analytics. Mike, you mentioned the wheat markets earlier. Let's dive in there and get some thoughts. I know we saw very poor crop ratings come out earlier in the week for the Kansas hard red winter wheat crop, especially the state of Kansas. Walk us through what you're seeing in this wheat market overall. What are some things you're keeping an eye on?
Yeah, I think the big thing that I've noticed here, Jesse, is the linkages between wheat and crude oil, both hard red, soft red, crude oil. Now the European Union futures prices, it's been a bottomless pit for the European wheat futures. And we've actually seen European wheat now go to the lowest levels since August of 2021. That really matches up well with the WTI crude earlier this week, making its lowest level since I think early December of 2021. And then you go back 3 weeks ago, soft red wheat went down to its lowest levels since mid-July of 2021, and the hard red down to its lowest levels, I believe, since August of 2021 or September of 2020. So you see these real clear linkages. This is the funds. This is not the supply demand fundamentals. And as you say, not only do we have a tough crop here in the United States, hard red wheat belt, but the EU marketing year exports year to date are up 8%. And so we've got a situation where that's going on. And then the Ukrainians, their grain crop almost falls every day. We come out and there's a new fresh flash newswire report. And by my calculation, their grain crop, total grain crop, could be anywhere from 34 to 44 million metric tons. That's going to be down 45 to 60% from 2021 and that record 86 million, I think it was. So I think I just want to get through to the listener and to the viewer here today. We're still on this commodities are an asset, not commodities are a commodity based upon supply demand fundamentals. I'm hoping this Federal Reserve marketplace action that we see today, and also the fact that the Chinese Russian conversation and meetings are over with, that we kind of get back to supply demand fundamentals. And we do that with the USDA reports, especially.
You stole my thunder. I was going to ask you how much the China Xi Jinping meeting with President Putin in Russia, how much that has factored into some of this outside headline news chatter in the market this week, Mike.
I think quite a bit. And they talk specifically about natural gas and crude, more going to from Russia to China. And now Putin has been reported this morning. He also said in some of the European papers that he's looking at getting more agriculture commodities out to China as well this coming year. I think that's probably the heart of the fund liquidation, along with these currency markets and the pre-Fed nervousness, Jesse. So I really am nervous about the deglobalization mindset that you and I have been talking about for better part of probably 3 or 6 months, with that new East, new West trading geopolitical blocks that are setting up. That's the biggest fear that I have in 2023. And it's probably the biggest issue that we're going to have to contend with, where the demand maybe doesn't come through as well as we want. We're going to have to keep relying upon weather and supply. I'm not saying demand's bad, but I think that the demand going up given the conditions of our trade and our relationships with some of the biggest commodity importers and biggest competitors like Brazil, it's not going in the right direction.
Let's talk livestock, Mike. Let's start with this cattle trade first. I'll pull up one more chart on the video feed for us to talk through. Cattle, I have to think that some of the moves in the cattle market this week have been tied to A, the outside market concerns, but also B, that cattle on feed report Friday, pretty much as expected. Walk us through this lead month live cattle chart and give us your thoughts on this cattle trade overall.
Yeah, I agree wholeheartedly with you. And I think the cattle on feed report was slightly positive, and it's probably 2 months in a row now we've had a slightly positive report and didn't do anything with it. And it does go back to those macro fundamentals. And it goes back to the hogs, which are also attached to the macro fundamentals, especially in relation to the Chinese. It's not a coincidence, Jesse, that we've seen both the soybeans and the hogs fall pretty dramatically this week in percentage terms. So this chart is kind of it's kind of stand up here, or we're going to have some problems with the funds. That's kind of how I read this chart. We hit a new monthly low in the April contract today of 160.63. We tested the purple trend line very seriously, even ate into it a little bit. We came out, though, swinging on the close, and we were able to see some short covering April getting back up above 162 the last time I looked. So I can breathe a sigh of relief. I can say there's no technical damage done here, but notice at the bottom of the chart, along with that purple trend line, you've got a beginnings of a sell signal where the purple line is crossing over into the green line. That's what I would dub a sell signal on that oscillator. And that oscillator is all about momentum, and that momentum I trace back to the funds. And so if we lose the purple trend line and we get that sell signal in the oscillators, we have very little support in the fat cattle market, technically speaking, in the futures until we get all the way down to the solid green line that's drawn off the 2020 lows. So essentially $10, $11 lower. I can't rule that out just because of how the funds have been in control of this market and not the fundamentals. So cattle producers, be on guard for that. And having said all that, I think that the August contract being so discount to the April, I'm looking for a place to buy August fats in order to maybe try and add to some of my per head losses in terms of cash marketings now if I'm a cattleman. So stay close on that, because this could be the time to do it, or we may have to wait another week or 3 weeks.
How about that hog market? Man, I tell you what, I can't find anything good to say about this hog market, Mike. Seems like every week the last month or so, you and I have been talking about it, and seems like we always talk on another down day. What's your thoughts on hogs?
The good thing about the hog market is the domestic market. It's been overshadowed by the foreign market, specifically the Chinese market, and even the African swine fever. It has not picked up any kind of sizable short covering, let alone long positioning in the hog futures, Jesse. Even though we had an Easter seasonal, it should have been friendly for us the past couple of weeks. Everything's been counter seasonal and everything's been focused on the foreign side. Coming through that, we still have a cutout that's around 80. We still have a cash CME index around 79. I'm still in the camp that $80 is a good solid footing for the cash market, and therefore it's going to be a good solid footing for the April futures, because the index and the futures are going to be coming together in the next 3.5 weeks. So I think we're on the low end of the spectrum unless something new comes out that would be negative in terms of the hog trade with China or some other big country.
Well, I know we're watching African swine fever worries in China, of course. One thought I had to pick your brain on, we're seeing some more reports of HPAI in parts of the Midwest with flocks, chicken flocks, etc. And just thinking about maybe folks, as we get into the grilling season, if they're trading down from beef to pork to chicken, but if we got HPI worries with chicken, I just wonder if we could be maybe setting something up there that bears watching possibly, Mike.
I think we could. Now, we know that the HPAI is probably affecting the egg-laying birds more than the meat birds, but having said that, protein is protein. And so to your point, I think we will see a consumption shift away because of the price of eggs not coming down at all. And yeah, you got to bake with them, but that doesn't mean you have to, cook with them as much as you normally do, or go out to breakfast and eat as much of the breakfast foods, and you kind of skip into lunch or something like that. And so I do think the pork is well positioned for that at this stage of the game, Jesse. And I think that's another reason why I think domestically speaking, I don't see a lot of negativity in the pork side of the equation right now. And I'm still hearing from hog clients that there are some PRRS out there, especially near the Ohio River and east of the Mississippi River. In other words, Indiana, Ohio area has got some PRRS in it still, and it's been that way for the past few months. So I'm thinking the cash market, much like in the corn, the cash hog market's going to come in and support this market as we get past the Easter holiday.
Well, Mike, great thoughts as always. Before we let you go, anything else you want to mention or reiterate for folks here before we run out of time today?
Just keep an eye on that dollar and that crude oil. We could be through the worst of it at this point now that the Federal Reserve's out, and we'll see what USDA says, but maybe we don't have any more macro headwinds for a while as we go into that acreage and stocks report. So get a trial on the website and keep track with me.
And where can folks find you on that website, Mike?
Yeah, go to globalcomresearch.com. It's globalcom with 2 M's, research.com.
Fantastic. Mike Zuzolo, Global Commodity Analytics. Always a pleasure, sir. Have a great week, and we will talk to you next week.
Great to be with you, Jesse. Thanks for having me.
And that's all the time we have for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.